This is the answer for question number 7 on the prep exam. Question number 7 deals with the sale of inventory to customers. So as you recall, from every sale transaction, there are 2 things we need to record in our general journal. One is the sale itself to the customers, and second is the inventory movement that we have. The sale is pretty easy. The sale is 800 units for $1.2 million. So we've got $1.2 million of sales revenue. So that's sales revenue of $1.2 million. And that is on account, so that's accounts receivable that our customers have said they will pay us. So accounts receivable is a balance sheet asset item that will keep track of that receivable, and the sales revenue is on the income statement to show the sales that we had. The second part of this is a little bit more challenging. That's the inventory portion. We've got to figure out what the cost of goods sold is. The account part is easy. We know inventory went out the door. It's more the value that we're going to have to come up with. And with inventory going out the door, that is the cost of goods that we sold. So those are our accounts. That's the easy part. Hard part is, what is it? Well, that depends, the value, on whether we're using LIFO or FIFO, whichever method we might be using in this. If we were to start with LIFO, LIFO is last in, first out. That means the most recent stuff is the stuff that we wound up selling to those customers. Well, if you'll recall, in question number 6, we bought some stuff, didn't we? We bought 1,000 units for $500,000. But in this question number 7, you'll also see that we had a beginning inventory of 800 units for $920,000 in the problem. So under LIFO, the last stuff in, or that stuff we bought in number 6, was the first stuff out. So it was the stuff that we actually sold. The old stuff is still here. So we've got to figure out how much of that 800 units the value would be. Well, as you can see, we bought 1,000 in question number 6 for $500,000. So if I take the $500,000, I divide it by 1,000, that means it was $500 per unit. We sold 800 of those $500 units, or those 1,000 pieces that we had from that purchase. So 800 times 500 is 400,000. Giving us a nice profit, the difference between the two. That's the LIFO method. But it could be the FIFO method. The FIFO method, if you'll recall, is first in, first out. That means all the old stuff is the first stuff we sell. The newer stuff is still in inventory. So that means those 800 units came out of that beginning inventory. So that beginning inventory, 800 units, that's pretty easy. It's the whole 920,000. You can see in this problem, our profits aren't as good when we used the FIFO method. Must be we're in a situation where the price has decreased significantly, and it has. So we've got a cost of goods sold that is the entire 800 units. Now I want to just help you with the FIFO side of things in case the numbers were a little different. Let's say that we only sold 600 units, okay? 600 units, and 800 of them were in beginning inventory. Well, that's easy. We would just multiply the 600 units times the 1150 that we had for beginning inventory. Now, if it was 900 units in FIFO, that means this whole 800, or $920,000, would be part of it. but we still got to come up with another 100. And that 100 would be coming from the purchases we did on question number 6 for $500. So we'd have the whole $920,000 for 800, plus we'd have 100 units at the $500, or $50,000. So our FIFO, if we had gotten 900,000 sold, would be a mixture of all the beginning and some of that purchase in number 6. I hope that gives you enough explanation so that you can handle both LIFO or FIFO questions, realizing that you might have to use some or all of each of these inventories from the beginning to the number 6 question to figure out what your cost of goods sold is. And those are the answers for number 7.